The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. The global bond market is at an interesting crossroads. Investors are watching closely as expectations build for U.S. interest rate cuts, while currency markets, especially across Asia, respond to shifting rates. Across Asia, credit markets have shown surprising resilience, but high-yield segments are starting to raise caution flags. At the same time, investors are searching for yield beyond traditional safe havens, with heavy corporate issuance testing appetite and liquidity. And in the Middle East, Saudi Arabia and other Gulf issuers are tapping international debt markets like never before, signaling growing confidence in the region, but also raising questions about risks. To find out more, I'm joined now by Kheng, who is the Asia-Pacific head of fixed income at State Street Investment Management. Siang, welcome back to the show.
Thank you.
Thank you so much for joining us. Well, Siang, markets are increasingly pricing in more U.S. rate cuts for the year ahead, with optimism rising after recent inflation data came in line with expectations. Now, at the same time, there's shifting interest rate differentials. They're influencing flows into and out of currencies, especially in emerging markets in Asia. So given the growing expectations for more rate cuts in the U.S., how do you see that playing out in global currency markets, especially for Asian FX and dollar-pegged regimes?
Yeah, I guess given the increasing expectations of the U.S. rate cuts, one will generally expect that the dollar may weaken a little bit. But at the same time, that's just looking at the interest rate differentials alone. There are many factors that would affect the trajectory of the U.S. dollar. So if you just look at the current world situation, while the U.S. is cutting rates, that also means that other emerging markets or Asian countries may also have more leeway to cut interest rates as well. I think at the end of the day, interest rate differentials, while it is an important driver, the other factors looking at the relative growth prospects as well as the fundamental developments of each country would also affect the pathways of the Asian FX. Now, I think given what we are seeing right now, we would expect the dollar may weaken a little bit, but right now at this point in time today, it's a bit different because of some of the events that took place happened in Japan with the LDP. So we have a bit of dollar strength. But in general, we may expect the dollar to kind of gradually inch a bit weaker over time. And so therefore, that would be positive for the Asian FX in general.
Well, are there particular currencies or regions you believe are vulnerable to abrupt reversals or currency stress then?
I think at this point in time, most of the Asian currencies that we are seeing in this region are on the appreciation path. The question is which currencies appreciate more than the others. At the same time, there are a few selected currencies which are at the moment undergoing through a little bit of weakness. That's mainly in the space Indonesia rupiah and Indian rupee. I think those are mainly driven by the fundamental factors in respective countries. In the case of Indonesia, it's mainly driven by the concern of the new president's policy in terms of trying to spend more and potentially will be weakening the fiscal discipline somewhat. At the same time, in the case of India, it's more of the recent kind of developments in the market, plus also the trade tariffs issue that's impacting the growth prospects of India. So I think right now, we do not expect a major shock to the system that will create a huge currency weakness. But at the same time, we may see, some currency movements quite sensitive to some of the capital flows and also headline news coming from the world.
Well, then, Asia's fixed income universe has been on this recovery path buoyed by a more resilient credit backdrop and structural reforms in local markets, yet caution is creeping into high-yield segments. What has been the main driver of Asia's fixed income resilience, and to what extent is that sustainable?
I think you look at the Asian fixed income market, it is supported by robust fundamentals. I think this is one of the key reasons that attracts foreign investors into this part of the region. What you just mentioned in terms of the credit market as well is also something that has attracted investors' interest, especially if you have been underweighting Asia for the past few years due to concern on Chinese high yield. Right now we are seeing there are measures being put in place to try to stop the worsening of the situation in China. And so therefore we have started to see money coming back in. Now the high yield segment, of course, can be a little bit tricky. The high yield segment will mean that, is higher risk. At this point in time, we have seen a fair amount of contraction in the credit spreads in that sector. So we would perhaps tell investors to be a bit more cautious on that. Investors in general are still looking for yield, to be honest. And so therefore, we still see that the Asian markets fairly well supportive. Investors are looking not just in the U.S., but they are also looking outside of U.S. And the stability and the various policy measures being introduced by the Asian authorities are comforting to them. So therefore, we have seen a fairly steady inflow into this part of the world.
Well, within Asia, which credit markets do investors prefer right now then?
I would think that investors, while they have some exposures into investment grade and also high yield, this juncture we feel that the investment grade credit perhaps could be an area that investors need to pay more attention to in terms of exposures, as it's more steady and stable given the uncertainty and volatility and also the recent outperformance in some of the highest credit spreads area. We may want to be more cautious. I think into this time of the year, we feel investors perhaps should be taking a more conservative approach to dial down some of the risks, given that we have a good run already so far this year.
Well, but then how much of Asia fixed income is still structural versus cyclical?
I would think a large part of the kind of Asian market, fixed income market support or interest or benefits are really coming from the structural element. Of course, there will be cyclical elements that would be swinging the countries from one way to another. We have seen over the years the Asian authorities, the central banks, all the governments, have been engaging the markets in a more transparent manner. And so therefore that has led to more investors' confidence in these markets. But of course, at the same time, there are cyclical elements that may swing from time to time. And these could be in the form of the government's policies, as you have elections and so on, and they react to different developments on the ground. And so therefore the policies being rolled out from time to time could also be a little bit more difficult for the markets to digest. And so therefore, on the whole, I would still say that the structural improvements in Asia will continue to carry forward this market.
Well, with global yields compressed and uncertainty in core markets, investors are pushing into, non-traditional fixed income segments. Emerging markets issuers are rushing to, tap debt markets to ride the risk on waves. So how should institutional and retail investors think about, diversifying fixed income away from U.S. Treasuries toward less conventional sources of yield?
While U.S. Treasuries obviously is a very safe bond market for investors to invest in, investors should also take note of there are other segments of the market which are also giving investors a combination of better yield and better diversification. At this point in time, given the expectations of the U.S. dollar continue to slowly weaken, we may expect investors should focus more on diversifying the portfolios into other areas of fixed income whereby they could benefit from that. So one area could be on the emerging markets. But of course, when you look at the emerging market as a whole, there could be certain areas or regions that could be more volatile. So I think from the asset allocation perspective, you need to be more nimble and careful in terms of making adjustments on your exposures and also picking the right time. To give you a sense of the performance year to date, for instance, the Asian local currency bond markets this year to date, is up around 8+% in dollar terms. And the global emerging market in local currency bonds, measured in US dollar terms, are up around 15.5% year to date. So again, these are very strong numbers that we don't see every year. But at the same time, investors would benefit from the diversification of these markets versus that of the U.S. Treasuries. While risk-return numbers are important, investors also need to think about some of the potential benefits of a lower correlations of these emerging markets to that of the U.S. Treasuries.
Well, also, flows into investment-grade bond ETFs jumped recently, even as issuance hit record levels. Now, companies like Oracle, they have been active issuers, pushing up supply, while ETFs are seeing strong inflows into investment-grade. How is the heavy wave of corporate issuance affecting, spreads and investor appetite for credit?
Well, the investors' appetite for credit has been relatively strong, to be honest, with, of course, the U.S. Fed's intention, as well as the most recent rate cuts that they delivered. Investors has been gaining quite a lot of confidence in buying credit. So a lot of new issuances that have been printed so far has been very well supported by investors. And so therefore, from that standpoint, we have seen credit spread compression, even despite the fact that we are seeing a high issuance amount from the corporate side. We think that investors will continue to remain interested in investing in credit, but the reason that they're still seeking extra yield pickup. So therefore, the heavy issuance so far this year has not turned out to be a supply issue that, in some instances that we have seen in the past.
Well, meanwhile, then, how has the surge in mega deals affected liquidity dynamics in the broader corporate bond market?
In general, the large deals that come to the market should help support the fixed income market in terms of secondary trading. But at the same time, the large deals, depending on the timing of how and when they are printed, could also affect some of the temporary hedging strategies adopted by the issuer as well. Now, at this point in time, we see that the large deals that comes to the market has been well absorbed by the market, so it has not affected much of the liquidity situation there. I would say that the general, bid-ask situation in the fixed income market is still very much contained, and investors are seeing the increasing trading volume as a sign that the market can deal with the large issuance as well as the gradually tightening credit spreads.
On the other hand, Saudi Arabia has been aggressive in sovereign issuance. In the first half of this year, it accounted for nearly 19% of non-China EM dollar debt issuance. Now, recent transactions include a $5.5 billion international bond to cover fiscal deficits and Aramco raising $3 billion via Sukuk issuance with strong order books. So what does a strong reception to Saudi and, Gulf region sovereign, quasi-sovereign issuance tell us about investor confidence in this region? And are we seeing, structural change in the way global capital views Gulf credit?
I think investors are beginning to pay attention to the region in the Middle East for the reason that, it offers you pickup to that of U.S. Treasury. But at the same time, the fundamentals in a number of the Middle East countries are improving. Now, taking the Saudi Arabia as example, they have increasingly over the years make a lot of efforts to try to diversify the economy away from just oil production or oil-related industries, right? And they have this Vision 2030 that the country is aggressively pushing. At the same time, we already have seen the growth numbers of the non-oil related sectors within the GDP segment have been growing at a faster pace than that of the oil sector segment. So therefore, that is a good sign to show that the economy is trying to transform and transition away from its traditional core bread and butter industry, which is oil. Now, that doesn't mean that Saudi will abandon its oil industry, because that's still their key thing that they will continue to do. But I think for the forward future developments, they would want to develop into a more diversified economy. And that's happening across the Gulf region in general. And hence, investors are taking note of this trend in development and more willing and taking a more positive view on that sector. So therefore, as a result, the recent issuance that is taking place in that Middle East, plus also some of the fund launches that are happening in the Saudi Arabia or other countries, are gaining traction among the investors community.
All right. Well, then, are there red flags to watch, though?
Well, I guess the Middle East countries were now going through this reform or transformation. One needs to take note of how they are doing that, because the scale of the transformation is huge. Now, given that they have a huge oil reserves as well as also foreign reserves accumulated through the years of their oil proceeds, at this point in time, they have the means to deal with that. While they ramp up the financing needs through the bond issuance, it is not a concern at this point in time. In terms of credit rating, for instance, on the Saudi Arabia, it has got a positive outlook. So as a whole, we do not see any real concern at this stage. But going forward, as they continue through multi-year period of fiscal expansions, we need to really look at how they manage the debt and how do they address that issue when the debt goes up, whether the growth can pick up fast enough to reap the dividends of what they have been doing right now. So that will be something for us to watch. It's not that a red flag that is there at this juncture, but it's something I think investors need to be cognizant of.
Right. Some great insights from you there. Thank you so much, Siang, for joining me today.
Thank you.
Thank you. That was Siang, who is the Asia Pacific head of fixed income at State Street Investment Management. This has been the Wealth Tracker with me, Hongbin, Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3